This is your ultimate guide to investing in 2024, a year that once again is marked with major uncertainty. Will we see rate cuts? Will the US national debt continue to skyrocket? And is the one-click investing strategy that's worked for so long still possible? On the surface, 2024 looks like a tricky year to be getting serious about investing, but that couldn't be further from the truth. In fact, 2024 may turn out to be incredibly important in the trajectory of your wealth. So whether you're brand new to investing or you're just looking to go deeper this year, this video will cover everything from the stock market basics to the most effective ways to put your money to work, and an exploration of the biggest economic and financial factors that are set to influence the markets in 2024. This video is sponsored by Aura, more on this later in the video. The stock market is one of the best places to build long-term wealth. Stocks, shares, or equities are a type of financial security which represent an ownership piece of a business. If you own all of the shares of a company, you own the entire company and can control all of the decisions in the business. And this is how most businesses start. They might have one or two owners who pool some money together and create a product or service to sell. But eventually, the business might need more money in order to grow, to expand their manufacturing capability, research product developments, or access customers in new markets. They could use debt, borrowing money from a bank for example, but that comes with regular interest payments and the need to pay the debt back within a few years. So instead, a business can also sell its equity. They can sell part ownership in the business. Part owners or shareholders don't receive regular interest payments, but they get a residual claim on assets and profits of the business, which can be much more lucrative than receiving small fixed payments if the business goes on to grow its profits significantly. This might start with the original owners selling large pieces of their business to a small number of private investors. But eventually, some companies will want to sell their shares publicly, so they do an initial public offering. The company stock will be listed on a stock exchange, and anyone with as little as a few dollars can become a small part owner. Stock exchanges are markets where buyers and sellers of shares are connected. The biggest exchange in the world is the New York Stock Exchange. It's where many of the biggest companies in the world are listed and their shares exchanged. Another you might have heard of is the NASDAQ exchange. Founded in 1971, it was the first entirely electronic exchange. It's also where many of the world's technology giants are listed, companies like Microsoft and Amazon. In the past, trades used to be executed on physical trading floors, with people manually making deals between buyers and sellers. Today, trades are executed using complex algorithms that perfectly match market participants at the best prices. If you have a brokerage account, you might have seen the terms bid and ask, or bid and offer. The bid price represents the maximum price a buyer is currently willing to pay for a stock. The ask, or offer price, is the minimum price that a seller would sell the same stock for. When a buyer's bid is higher than the current asking price, a trade or transaction occurs, and that price at which they transacted becomes the current stock price. About 2.4 billion shares are exchanged on the New York Stock Exchange every single day. So that's why when the market is open, there's always a live second-by-second update of a stock's price. When anyone says the stock market, they're referring to all of the companies that are currently trading on any exchange. The US stock market, for example, has about 3,700 companies listed across a variety of exchanges, mostly the New York Stock Exchange and the NASDAQ, but also a number of smaller exchanges. And the global stock market is even bigger, with almost 60,000 companies publicly listed and available for trading. So how do you become a participant in the stock market? Well, you don't deal directly with the stock exchange. Instead, you hire a stockbroker, which in the past was mostly like hiring an accountant. You'd have a real person working for you, and their job was to find good deals and facilitate the transactions with other brokers. Today, most people participate in the stock market by using an online brokerage firm. The brokerage firm may be a part of a larger financial institution like a bank, or they could be a standalone broker. In fact, many brokers today primarily function with just a mobile app. Lots of brokers will charge a fixed commission fee for every single transaction you make, whether it's a buy or a sell. So you'll want to consider this when you're making your investments and how it ultimately might affect your return. Other brokers will offer commission-free trading, which may be more attractive if you're investing small amounts of money at a time, but it's important to be careful of other hidden fees because these firms still need to make money from you in some way. So now you're equipped with an understanding of how the stock market works, let's dive deeper into some of the important market dynamics. What short-term and long-term factors drive prices up and down? Who are we competing against? And what strategies you should consider using in 2024. But first, a quick pause to talk about the sponsor of today's video, Aura. I'm sure you've noticed that spam phone calls have been getting really bad recently. In fact, if I receive a phone call from someone who's not in my contacts, I never answer the phone anymore because 9 times out of 10, it's just a spam caller. This is happening because data brokers who have collected your private information from businesses have sold your number to robocallers and spammers. This is where Aura comes in. Aura can identify data brokers that have exposed your personal information and submit opt-out requests on your behalf. Data brokers are legally required to remove your information if you ask them to, but they make it really difficult for you to do it, and there's always a bunch of hoops to jump through. So Aura can do it all for you. It's super easy to set up. You don't have to download a whole bunch of apps to get access to their huge portfolio of services, including parental controls, antivirus, VPN, password management, and more, all at one affordable price. Let Aura do the hard work of keeping you safe online and head to aura.com/Hamish Hodder to start your 2-week free trial. The link is also in the description below. There are many different opinions about what drives the stock market up and down in the short term and in the long term, so depending on who you ask, you'll likely get a variety of different answers. But I'll give you my understanding of the important market dynamics from studying and investing in the markets for many years. The price of any given stock is influenced by 2 key elements: short-term fluctuations and long-term trends. No stock has a price chart that just goes up a little bit every day in a straight line. They bounce around day by day, week by week, month by month. And there's a lot of factors that play a role in these small fluctuations. There is a huge amount of focus on quarterly financial results of companies, and changes in expectations leading up to the release of each report pushes a stock up or down. No one has a crystal ball, so even though a company may provide guidance for what they think their revenue and profits will be, the projection and reality converge as time passes. Macroeconomic factors also play a massive role in stock prices. Inflation, interest rate changes, consumer confidence reports are all signals to investors about whether business conditions are worsening or improving. Are interest rates going to be lower, meaning businesses can borrow money more cheaply and grow faster? Is the labor market tightening, making hiring employees more expensive? Then there's liquidity. Large, highly traded companies are often very responsive to important news, whereas smaller, less followed companies may have more of a lagged response to new public information. Behavioral finance, an area of study that focuses on psychological factors, would argue that market sentiment, momentum, and other human elements also play a role in stock prices. Fear, greed, panic, euphoria are all irrational factors that can play a role in stock prices because at the end of the day, it's humans that are making the trades. So stocks move around a lot in the short term, but when you zoom out at a stock's performance over multiple years, you start to see long-term trends. Regardless of the short-term fluctuations, over time, a stock's price trend is driven by the company's ability to put money in shareholders' pockets. If a company is continually increasing its annual profits for 20 years, the stock will very likely have a strong upward trend over that period. The key word here is ability. Does the company have an increased ability to put money in the pockets of shareholders? Some companies will directly put money in shareholders' pockets every year. It's called a dividend payment. But others will retain their profits in the business, usually to buy assets to make profits grow in the next year. Even if a company retains all of its profits every single year, its stock could have an upward trend because its ability to deliver cash to shareholders has increased year by year. Take Alphabet, for example. They've never paid a dividend, so they've never directly paid shareholders anything. but every year their annual profit has increased. So the stock price reflects the fact that at any time they could just distribute huge amounts of cash to its owners. Another important market dynamic is the nature of the people actually participating. Who is it exactly that we're competing against? Well, most of the market is controlled by investment firms. About 30% of the stock market assets are held by US mutual funds, and another 30% is international mutual funds, pension funds, and hedge funds. The last third are retail investors, people like you or me. This is actually really important because while everyone in the market is presumably trying to make money, different participants have different goals, strategies, and external pressures. For the money managers who are running these investment firms, typically the more assets they have under management, the more money they will make. So their personal wealth is influenced by the deposits and withdrawals of clients. And the result of this is a very short-term oriented stock market. Every single quarter, their results are scrutinized, and it impacts whether clients stay, invest more, or withdraw. My favorite example of this is Peter Lynch's investment fund. He's one of the greatest investors of all time, earning an annual return of 29%, but a study by Fidelity Investments found that the average investor in his fund actually lost money. How is that even possible? Well, when short-term performance of the fund was good, clients invested more, often when stocks were expensive, and when short-term performance was bad, clients withdrew money, which was often when stocks were cheap. This pressure to satisfy the short-term emotions of clients leads to many money managers focusing on near-term factors, which often have nothing to do with the long-term trends of the company. It's a massive psychological advantage that the average retail investor has over the traditional finance industry. An advantage that you need because money managers have something we don't: resources. They have access to way more data than we do, with teams of sometimes hundreds of analysts poring over information to look for opportunities. And it's this exact dynamic which helps to guide us into which investment strategies are more likely to work in our favor. So let's talk market strategies. There's two main streams of thought when it comes to the stock market: trading and investing. Trading is a distinctly different approach to investing. Investing is buying a stock to own a piece of its business success, usually with the idea of holding onto it for multiple years. Whereas trading is the buying and selling of stocks to profit from short-term price changes, often done with little or no consideration of the underlying business. And the two different approaches, trading and investing, rely on two different types of analysis. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movements and volume. Unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. The key assumption in technical analysis is that past trading activity can be a reliable indicator of a stock's future price movement, and it's used a few different ways in the stock market. Investment firms might use trading and technical analysis to get the best price of a stock they want to invest in. So they've researched and analyzed the fundamentals of a business and decided it's one they want to hold, but they also want to use short-term signals as a sort of side dish to their main strategy. Whereas others might use trading as their entire stock market strategy, purely trying to buy and sell stocks as if they don't even represent pieces of businesses at all. You've probably seen a lot of so-called expert traders flaunting their wealth on social media. So is stock trading something you should be doing? Well, some people definitely do make money trading stocks over time, but it is extremely difficult and very competitive. And I would be very skeptical of the real results of the people who claim to be experts online. Ultimately, you need to decide whether the core assumption of trading makes sense to you. Can past price movements reliably indicate future price movements? Personally, I don't think so. Alternatively, you can take a longer-term view of stocks, which ultimately will be driven primarily by the profitability of the underlying business, which for most businesses is still very unpredictable, but that's not the case for every type of business. Let me introduce Warren Buffett. As if you haven't heard of him before. Buffett is one of, if not the most successful investor of all time, with a net worth of $120 billion. He runs a company called Berkshire Hathaway, a textile business that he bought in the 60s. Well, it was a textile company. Today, Berkshire is a holding company that Buffett has used to buy and invest in companies, including publicly traded stocks. His strategy has been to follow the principles of value investing, which has the fundamental assumption that a stock's price isn't always an accurate reflection of its value. Short-term factors and investor psychology can cause a stock to be cheaper or more expensive than it should be, which is a fascinating idea because it means that risk and reward aren't necessarily joined at the hip. You've probably heard somebody say at some point, if you want to have a high reward or high return, you have to take a lot of risk. But that's actually not true in the stock market. Markets can become overly pessimistic about a business. So theoretically, you could buy a safe, growing business that has a low risk of failing while still earning a high rate of return because you bought it at a cheap price. Like all the high quality companies that saw 30 to 50% stock price declines during the global financial crisis. Great businesses that were selling cheap because of irrational fear and short-term macroeconomic factors. Value investing has evolved a lot over the years, but it was built on some of the ideas of Buffett's university lecturer, Benjamin Graham. Graham is famous for saying that in the short run, the market is a voting machine, but in the long run, it's a weighing machine, which is the same concept that I was talking about earlier. Short-term factors push a stock around on a week-by-week basis, but over time, it's the strength of the underlying business which drives its price. Buffett's success came from combining some of Graham's ideas with ideas from other investors such as Charlie Munger and Phil Fisher. His modern value investing strategy can be summarized with 4 key elements. The first is having a deep understanding of the business, knowing the specific industry and the market as if you were running one of those businesses yourself. Buffett calls this his circle of competence. Only invest in what you know well and happily ignore anything that is beyond your capability. The second is the idea of economic moat. Some companies, whether it be due to natural industry factors or intentional business strategy, are able to build a protective layer around them, reducing the ability of other businesses to compete. The third is to ensure the company is run by an excellent management team. We're only ever going to be a small part owner in a company, and we have little say over who actually makes top-level decisions, and those managers will have a big influence on the success of the company, so we need to assess them very carefully. Lastly, a good business does not equal a good investment. A good investment is buying a good business at an appropriate price, so having a method for calculating an approximate value of the company is critical. That way we can ensure that we only invest at a price that makes sense. I've got a detailed checklist of these principles available for free on my website. I'll leave it linked in the description below if you want to take a look. The strategies that we've discussed so far have all been active strategies. They take an enormous amount of work, they're extremely competitive, and truthfully, most people just don't make money from picking their own stocks. Hell, even most professional investors end up underperforming the market. But there's a much simpler approach that's likely appropriate for far more people. Passive investing. Individual stocks and companies come and go all the time, but over the entire history of the US stock market, it's gone up. There have been long flat or declining periods, but over any person's working life, the market has always been significantly higher, which means if you're investing for retirement and long-term wealth building, simply owning a piece of the entire market would have worked really well. This is where index funds can help. There are a few big investment firms such as Vanguard and BlackRock which have some index fund products. You buy one stock, the index fund ETF, and you can own a piece of the whole market. And the buying strategy for index funds is also pretty simple. Either dollar cost average, which means having a personal plan to set aside a portion of your salary and invest at regular intervals, or alternatively, you can just lump sum invest, meaning you just invest immediately when you have money available that you're willing to put away for the long term. Lump sum investing has technically done better than dollar cost averaging in the past, but both are great strategies. And I personally think that setting up a dollar cost average strategy is also good for your own investor psychology because you can actually build the habit of investing regularly. There is, however, a very big asterisk that goes over passive investing. You'll see a lot of people on TikTok or Reels quoting the 8 to 10% per year market return from the past, and then projecting their own wealth into the future using these figures. And while the US market has done very well for a very long time, there's absolutely no guarantee that this will continue. Being a passive investor means that you're accepting whatever return the market ultimately delivers, and that will mostly depend on the growth of the US and global economies. Other developed countries have gone through very long periods of stagnation, so it's important to keep your expectations in check. And ultimately, whatever strategy and portfolio composition is appropriate for your own personal circumstances will depend on your own personal circumstances that you should discuss with a financial professional. So let's talk about 2024 specifically, because it's actually a rather unique time to be getting involved in the markets. 2023 was a huge year for stocks. The US stock market was up over 20%, which puts it at one of the best years in its history, much higher than the 8 to 10% average. The housing market in the US, as well as in Australia where I live, saw massive increases in home prices, and a lot of the macroeconomic concerns have seemed to fade away. Inflation continued to fall quite aggressively, the rate hike stopped in early 2023, and the economy isn't showing any signs of slowing down. No recession, which was highly anticipated. Of course, all of this is good news, but good news in financial markets can from time to time breed over-optimism, and things can shift very quickly in a very short period of time. The Federal Reserve rate decisions will likely still be a big story in 2024. The current expectation is that the Fed will cut rates for a total of 80 basis points across 3 separate cuts. And that expectation is based on the idea that the Fed has successfully rid the US of inflation, so rates can go back down. This certainly isn't a guarantee. Plus, the Fed is likely to be very careful to avoid the mistake that it made in the 70s inflation crisis. If they lower rates too soon, they could trigger a second, larger wave of inflation, and rates may need to go even higher than before. So just remember that whatever actually happens in 2024 could and very likely will be very different from the current expectations. And on that note, while headline US inflation is now just 3.1%, core inflation is still 4%, which is twice the healthy level, and we've seen inflation swing up and down very quickly over the past couple of years. These factors and others will very likely push stocks around up and down throughout 2024. Be prepared for this and know that if you're a long-term investor, then these factors don't really have any impact on your long-term results. Every year I've tried to level up the value and quality of the content on this YouTube channel, and 2024 is no different. So make sure you're subscribed so you don't miss any of the great content that I'll be putting out over the next 12 months.